Hi, I'm John Pasalis, housing analyst and founding broker at Philosophy Realty, where I lead our team of agents in providing data-driven real estate advice to home buyers and home sellers throughout Toronto and the Greater Toronto Area. We launched this Toronto Real Estate Summit because we're getting a lot of questions from consumers about the volatility in our economy and our housing market that was brought on by the COVID-19 pandemic. So we're going to be talking to leading economists, housing industry leaders, personal finance experts, and real estate agents to get a better understanding of what's going on in our markets today and what are some of the key things that we should be looking for in the months ahead so you can all make smarter real estate decisions. If you have more specific questions about your home buying and selling needs, please feel free to email me anytime at askjohn@movesmartly.com, and I hope you enjoy this interview. John Pasalis here from Philosophy Realty. Right now, I'm going to be speaking with Kevin Bryan. Kevin's an assistant professor at the University of Toronto's Rotman School of Management. His primary area of research is strategic management, but Kevin's one of these professors who knows a lot about a lot of different areas of economics, and is one of the reasons I really enjoy talking to him. You can see this through his fantastic blog called The Fine Theorem, and you'll see that today as we talk about some of his experience working at the Federal Reserve leading up to the financial crisis, and some of the key papers that might help us think about some of the different dynamics we're seeing in our housing markets today. So let's jump into my chat with Kevin Bryan. Kevin, thanks so much for joining us today for our Toronto Real Estate Summit. Really looking forward to getting some of your insights and experience and thoughts on some of the research when looking kind of at the U.S. housing bubble, crisis, and sort of what lessons we can take from them and sort of looking at today's challenges with COVID. So thanks so much for joining us today.
For sure. Glad to join you, John.
Awesome. So let's just jump right into it. So, one of the things I was really interested in talking to you about today was, your experience working at the Federal Reserve leading up to the financial crisis. But, before we kind of talk about that, I thought it would be helpful to kind of talk about an important speech that then Governor of the Federal Reserve, Bernanke, gave in 2005 that described how a global savings glut was contributing to pushing mortgage rates down and to their housing boom in the US. And maybe you can kind of unpack that idea for our viewers today.
Yeah, so this is definitely the big idea floating around in the mid 2000s. Ben Bernanke gave a speech in 2005, then pushed the idea, even after the global financial crisis started, that what's going on? Why are we seeing these? Both monetary policy being somewhat ineffective when it comes to moving asset prices, but also kind of weird patterns of asset prices worldwide. The most obvious one being a huge run up in house prices, not just in the U.S., but in Spain and in Singapore and in the U.K. and many Ireland, many places around the world. So what was going on? Essentially, he said, look, we just had a huge shock to the amount of savings that people want to do worldwide. And where's it coming from? It's coming from basically quickly growing developing countries. So you've got these countries like China that at home, they do what's called a financial repression. So financial repression, it's a little less the case today, but definitely the case in the 2000s, means that you deliberately keep the interest rates that a saver can earn low. So the stock market was fairly undeveloped, and if you put your money in a bank, you would get super low interest rates. Basically, the government would manipulate this to be able to have money to spend on the government side and to push money into real investment. Mm-hmm. So you have all this capital, huge amounts of capital in countries like China that are looking for a bigger return. You also have these big national investment funds like you saw in Singapore and Norway, and many other countries started setting them up. So you've got a huge amount of money looking for returns at the same time. Mm-hmm. They used to buy bonds, which are relatively safe, but the problem was so many people wanted to buy these bonds, things like US Treasury bonds. The interest rates were effectively in real terms zero. Mm-hmm. And so all this capital is looking for, where can I get a reasonable return reasonably safely? And the money started plowing into things like commercial and residential real estate lending. Mm-hmm. And so his hypothesis is, what's going on? Well, regardless of what the Federal Reserve does, the interest rate you can get money at to build is just very low. around the world. And so people are going to take that money and they're going to buy housing and buy commercial real estate. So that's the global savings glut hypothesis. He famously, in early 2010, at the American Economic Association, he gave kind of a keynote address as he was leaving the Fed, and he said, basically, what happened to housing prices? This is the best explanation we have.
So basically, all of these foreign governments, companies, whatever, want to put their money somewhere safe, and they're basically kind of pushing them into these bonds, originally kind of US bonds, and then eventually mortgage-backed securities. And because everyone's plowing their money into it, that's kind of driving the interest rates on those bonds down, right? Okay.
Yeah, and I should mention it wasn't just developing countries, it was also the aging of developed countries.
Okay.
So, of course, you save when you're young and you spend when you're old. So as you have a bunch of people looking forward to retirement in the next 10, 20 years, then you've got a big chunk of capital that's starting to move away from stocks and into what they would consider safer assets. So they also would like to buy a bunch of treasury bonds. Okay. But so all this money, it's just you look around the world right now, this is kind of crazy in this COVID situation. Deficits basically in every developed country in the world on a monthly basis are essentially the highest they've been outside of wartime ever.
Yeah.
And yet the real interest rate around the world is negative.
Yeah.
So how could this possibly be? It's like, well, there's a lot of people looking to save their money and earn anything on it, even positive nominal return, but a negative real return. So after accounting for inflation. Yeah.
So, maybe I was going to ask, before I jump to my next question, actually, to just kind of raise something that I thought about now is, if this was kind of the narrative in some ways, sort of one of the reasons that rates were super low and were kind of fueling this bubble, why then did basically the Federal Reserve sort of jump into this pool of savers effectively by buying bonds after the crash? Like effectively, if this is kind of part of the problem, if we want to call it that, it seems counterintuitive that they're jumping in and buying hundreds of billions of dollars in bonds, becoming one of the global savers effectively. So what's
Yeah, it's really tough, right? So a financial crisis happens.
Yeah.
People are out of work. We would like to, prime the pump as much as we could. So we'd like people to start investing in real assets and get people back to work. And it turns out we don't have that targeted a way to do it, right? With monetary policy. So there's been a big debate in the literature on, when we try to lower interest rates during a recession, are we just inflating asset bubbles as well? I think the literature would probably be on the side of the Fed is that, as we'll discuss, it's the asset bubbles we've seen are not first order driven by Fed policy.
Okay.
So the Fed still can change some real investment by manipulating interest rates. And the global savings glut hypothesis maybe was not as accurate, and certainly not over the last decade, as Bernanke may have thought once people tried to model this. So you can think of it as a hypothesis. So it was coming, it wasn't coming out of the standard models that we had. Ben Bernanke is a very, very, very famous academic economist.
Yes.
He's probably the world expert on the causes of the Great Depression. So he's perfectly capable of reading the literature. The problem is we just didn't have very good models that link financial sectors to real sectors and how monetary and fiscal policy is going to affect things. Whereas obviously since 2008, thinking about how changes in the financial sector are going to affect the rest of the economy is probably the main thing the macroeconomists have worked on for obvious reasons.
Are you finding that sort of the global savings glut argument, it's obviously true in the sense that there was this obviously big demand for savings, but maybe that in and of itself didn't necessarily explain sort of the rapid surge in assets like house prices?
Yeah. So the explanation would be something like this. If I gave you $10,000 for free, what are you going to do with it? So it's pretty clear you're not just going to buy assets like housing. You might consume some of it. You're like, hey, I've got more money, so I'm gonna buy more clothing, more restaurant meals, more travel. I'm going to take some of it and I'm going to invest it, not necessarily in fixed assets. So I'm going to take some of it and I'm going to invest it in companies that are growing.
Mm-hmm.
I'm going to take some of it and invest, because the reason I get a return from my investments, hopefully, is that I take my money and turn it into products that are worth more than the money I invested.
Yeah.
And maybe I'll take some of it and invest it in fixed assets. I'll buy, I don't know, gold or housing or whatever it happens to be.
Yeah.
And so the story needs to be, how come when we see this big amount of savings that come into the world, one, why isn't that being consumed if the interest rates are so low?
Mm-hmm.
And two, why aren't people investing it in real assets?
Mm-hmm.
If you look, since 2009 to today, had you invested in, say, just the stock market, so you can think of that as average real assets, you would have done very, very, very well. So we effectively had, a 3.5x, a 350% or so increase in the S&P 500 over 11 years.
Yeah.
That's a huge, huge, huge return. And so if there's supposedly all these people with all this money, the story needs to be not just, that the money exists, but like, why are they investing in fixed assets and not real assets? It's weird, right?
It is. I mean, you're 100% exactly. When you put it that way, it does seem a little bit. It does seem a little bit odd, given the returns they could have gotten just even investing it. You're right in S&P index for 10 years.
I mean, imagine you're in China. I know the financial system wasn't quite as well developed, but investing in growing Chinese companies in 2009 to 2020 would not have been a bad idea. You know, it would have been great to have been an investor in like Alibaba and Huawei and these kind of companies.
Yeah.
So we need more than just the global savings glut to generate the patterns we've seen and to be the cause of the asset bubbles we've seen.
Yeah, that's super helpful. Now, one other thing I was going to ask you was, I was interested in kind of hearing your insights on your experience at the Federal Reserve, and in particular, sort of the fact that leading up to the summer of 2008, most bank executives in the US and even the Federal Reserve thought that they had sort of this subprime crisis under control, and they thought they neglected the big risks they neglected the big risks that led to the collapse of Lehman Brothers in September 2008 and the financial crisis that followed. And this is the scenario that economists Andre Schleifer and Nicola Giannoli describe in their book, A Crisis in Beliefs, where they discuss their model that suggests that this strong demand for safe assets that we just kind of talked about and this neglect of downside risk led to the financial crisis. So I'm wondering kind of what your thoughts on their idea of neglected risk leading up to the financial crisis, and what lessons, if any, we can take from their research in today's environment where, most big banks today are pretty upbeat about housing, I find.
Yeah. So it's quite interesting. So you mentioned I worked at the Fed. I'm not that old, so I was really, really a young buck at the time. It was kind of fun. I was working with the Economist there, so I did get to go to like the pre-FOMC meetings before, Bernanke and all these folks would discuss. And I think in February 2007, I even wrote a memo for the Federal Open Market Committee on the housing bubble.
Okay.
So sometimes people suggest, no one understood that there was we talked about it all the time. Like, people aren't stupid, so they can see a huge run up in housing prices.
Yeah.
The interesting thing, though, was what problems that's going to cause afterward. So if you were in 2007, you can look back and see what people were discussing.
Yeah.
We were actually probably more concerned about two things. One, there's a huge run up in oil prices in 2007. Oil price run-ups have been triggers of recessions a number of times in memory. And two, there was a lot of worry about a reverse of hot flows in the U.S. into the U.S. dollar. So there was a lot of kind of relatively fickle investment coming into U.S. dollar assets. And if you think of things like Argentina or Mexico during the peso crisis, when those flows reverse, it can cause a huge financial problem for the country when they come to. And so there was a lot of people trying to figure out, is oil going to be a problem, or financial flows going to be a problem? People thought with housing, it's like, okay, fine, we understand that this may reverse, but it hasn't really been a trigger of recessions because we more or less know how to handle a drop in the value of assets. So if you think like 2001, NASDAQ collapsed, So there's a huge destruction of wealth due to NASDAQ, and you can just handle that with totally standard monetary policy. So it didn't lead to a second Great Depression.
Okay.
So Ben Bernanke, obviously, he talked about he wanted to kind of let the air out the same way you hear in Canada today. Slowly, it didn't really work. The house prices fell relatively rapidly. But I think if that's all that was happening, the Federal Reserve could have cleaned that up. It wouldn't have caused a huge recession. The problem, as you mentioned, was this financial contagion. So these banks and real firms were lending to each other, including overnight loans to make payroll. And so you see Lehman Brothers collapse because of their subprime lending. And now everyone's like, wait a second, I have basically loans out to this other bank that they're supposed to pay back tomorrow. I figured that's essentially no risk. Now I'm not so sure. So now I'm not going to give those loans out. And now the other bank, they're not going to give loans to the companies to make payroll. And you essentially see a run on the bank. If you've seen the movie It's a Wonderful Life, when everyone tries to run into the bank at the same time, as long as everyone doesn't take their money out at the same time, it's not a problem. But if everyone take the money out at the same time, there's no money. So with banks, we solved bank runs by essentially guaranteeing your bank account. With these overnight loans or these short-term loans between financial institutions, there's no such thing. And so we essentially had a run on this dark financial sector that was not really anticipated, including by the people in the financial sector, because it wasn't really something you'd seen before. And the Federal Reserve had to use all sorts of really crazy policy to try and clean this up. And even worse, it was global. So a lot of the biggest problem banks, Deutsche Bank and SNF and Royal Bank of Scotland, they were heavily invested in these kind of mortgage assets also. So people didn't want to give them money either. So that's essentially the situation that we found ourselves in. Today in Canada, is it just that the banks have crazy beliefs, or is there something bigger we need to worry about, right? So what would be like a real tail risk in Canada is like, well, the government, things related to CHMC, right, would be a problem. Right? I mean, huge amounts of assets. I know you've talked quite a bit about the kind of the shadow lending sector. So a number of people effectively taking out second mortgages at a very high interest rate to cover their down payment. We're not really monitoring that well, as far as I'm aware. Changes in financial flows from abroad can be very rapid, and if those play an important role in Canadian housing, that would be a problem. What's worse is we don't really even know. So even just measuring what percentage of buyers live abroad doesn't tell you. Like, I mean, a lot of domestic buyers could be getting their down payments from abroad, for example. And we're not measuring that. And so I don't think we're not going to see what happened in the U.S. happen again in Canada. But what would cause sort of a shortfall in housing prices to trigger something much more serious? I think there's a lot of tail risks people should be paying attention to. One of the ones that's actually two things in Canada are super different from the US is that loans are recourse. So in theory, they can go after me for my other assets if house fall more than my equity on the house. And the second thing that's weird is that there's no long-term fixed mortgages effectively. So the interest rate risk that Canadians hold is substantial. So we've been very lucky. Actually, even COVID probably made things better for housing, right? So it drove interest rates even lower. But if we saw like a 2 percentage point increase in interest rates, what would trigger that? You can see all sorts of things like a change in the policy of countries like China or India on how they're going to handle foreign flows of cash. It absolutely changed the interest rates worldwide. 2 percentage points is not huge by historic standards, but it would cause big problems for people that have to refinance. So so I think it's just probably not good to think how do we avoid what happened in 2008 in the US. I think it's better to look at all the many financial problems that have been caused by housing worldwide over 200 years. You can go back to my favorite housing bubble. A lot of people like the Florida land rush of the 1920s, which is really good because one of the main investors in the Florida land rush, it was when people started moving to Florida, basically we had treatments for malaria, and so it started to be very attractive with the weather. and a guy named Charles Ponzi, Ponzi, happened to be one of the people selling real estate down there. And in retrospect, you're like, I shouldn't buy anywhere where a guy named literally the Ponzi scheme is named after is involved. But an even better housing situation was in Chicago in the early 1800s.
Yeah.
So huge increases in housing prices in Chicago in 1810, 1820.
Yeah.
And this one's a really interesting one because most of the time we look back at these big housing increases, we're like, what a mania, what a bubble, what a, Charles Kinderberger had this, the madness of crowds, he called it.
Yeah.
But in Chicago, they were thinking, there was a rumor that people were going to build a canal that would connect the Great Lakes to the Mississippi River and was going to go in Chicago.
Mm-hmm.
And in fact, they literally built that. You can go to the Loop in Chicago and see the canals that you can follow them all the way down to the Mississippi.
Yeah.
So it turns out if you were buying land in like the prairies in 1820, you definitely should have bought the land in the Loop in Chicago. So it wasn't right? These big increases in house prices have all sorts of causes, and of course, like speculation plays some of the role. Yeah. So you just want to look at like if the investors are wrong in their optimism, what problems is that going to cause? They might be right,
Yeah.
And that's something we should always have in mind. Another situation that caused a permanent increase in the level of housing in the U.S. was the introduction of 30-year fixed mortgages. So you can look at like the National Housing Price Index.
Mm-hmm.
There's a permanent jump around the time these mortgages are introduced. It's not that surprising.
Didn't they introduce those like in the 30s?
Yeah, exactly. Yeah.
Right. After I think right after the Great Depression, right?
That's right. Yep. And housing prices, went up, something on the order of doubling on average, and never really went down again.
Mm-hmm.
And part of this is like there was a huge number of people who effectively had no assets and were never going to be able to buy housing, and they were just renting, and those people kind of built the suburbs effectively.
Yeah.
With 30-year mortgage. So sometimes housing price increases aren't bubbles. Often they are. Like we have, we have no shortage of 30, 40, 50% declines in regional house prices, including in Toronto after 1989, right?
Yeah.
You go around the world, you can find them in Boston and Miami and LA and Singapore, Hong Kong, Stockholm, Dublin, Barcelona, London, Amsterdam, if you look into history. And so we need some explanation for how this keeps happening.
Yeah.
And what people have worked on, so you mentioned like Schleifer and his co-author, a number of other folks, Alp Simsak and Kurt Mittman, Gene Kaplan's been working on this as well. They've been trying to think, how can this increase in savings cause asset prices to go up?
Yeah.
And essentially the problem is it's really hard to model a rational bubble. So a rational bubble would be one where,
maybe if you can unpack what a rational bubble is, because I don't think everyone understands what that is.
Yeah. So a rational bubble is, I'm not a fool, so I know there's some long run link between housing prices and say rent prices, because people are going to decide whether to buy or to rent, and housing prices in the real economy, because people have to be able to afford their house.
Yeah.
But I think that, I'm going to buy a house not just to live in it for now, but also because I think I'm going to earn returns on the house.
Yeah.
And so I'm thinking the next person's going to buy it from me. Mm-hmm. And a rational bubble is trying to model this, assuming that the next guy is just as rational as I am.
Okay.
And so the problem is it comes up with something mathematically, we would call it the transversality condition. Sounds complicated. It's not complicated. All it's saying is that imagine that there's some cutoff where, a normal person would consider renting and buying to be, equivalent in the absence of returns.
Okay.
So something like, let's say if I'm paying 200 times my rent for a house,
sure.
At the current interest rates, I consider them about equivalent if I got no return on my housing investment. Okay. So I'm going to imagine there's a 300-to-1 gap between buying a house and renting. I might still buy the house because, this is less than Toronto today, right? Yes. So I might still buy the house because I think, well, I'm going to earn returns on it. So if I'm going to earn 8% returns per year, I really don't care what the house costs. Like, I'll buy it if it's $10 million. The returns are enough to justify what I'm paying. And so,
but you're saying if you're paying 300 times the rents, or
300 times the monthly rent.
A monthly, okay.
Yeah. So if I pay 300 times the monthly rent, I might buy it just for the return.
Yeah.
And I'm thinking, okay, the next person's going to buy it from me. But now we've got the returns up to 350. The ratio of price to rent is up to 350.
Yeah.
So the next buyer has to think, okay, I'm going to earn a return. When they sell, it's 400 to 1, then 500 to 1, then 600 to 1. And so the transversality condition essentially says we can't let that go to infinity. It doesn't make any sense. And since we can't let that go to infinity, now everyone who's rational can kind of think backwards and understand, okay, well, someone's going to be holding the bag at the end.
Yeah.
If I assume that person's also rational, none of this makes sense, so everything collapses.
Yeah.
So how are we able then to generate these house price increases? There's two ways in the literature. One is totally sensible, totally real, nothing weird going on. That's just that I think rents are also going to go up in the future.
Mm-hmm.
So like the Chicago land investor, why am I willing to pay way more than it would cost to like rent, I don't know, like a hut in Chicago in 1810?
Yeah.
Because I think that a city's going to grow up there and that land's going to be very valuable, which was correct, right?
Yeah.
Sometimes you see the opposite happen. If you're in like an oil town, actually the housing prices are relatively low compared to the rents. Why? Because we think that town's going to be abandoned in 10 years. So who wants to own the property, right?
Yeah.
So that's the kind of the totally, no one would quibble with that. You need quite a story to have a huge run up in house prices because basically real factors don't change that quickly.
Yeah.
So if you look at like, for instance, incomes year over year,
Mm-hmm.
the correlation between the average income in a city this year versus last year is about 0.25. So if incomes went up this year, they're likely to go up next year, though it's not that tight of a link. Housing prices have a correlation of somewhere between 0.6 and 0.7. So if housing prices went up last year in a city, they're likely to go up the next year. And so there's something more generally going on in housing than just the, I'm forming some belief about rents are going to go up also.
Okay.
So what's going on? These models, like the one you mentioned from Schleifer, they're essentially thinking, look, let's have a very different group of potential investors with different beliefs. Mm-hmm. Some people are very optimistic. Some people are very pessimistic. Mm-hmm. The interesting thing is the optimistic people buy housing. Okay, they think it's next year. Who has the money to invest? Some people bought housing in Toronto in 2014.
Yeah.
Some people bought bonds.
Yes.
We had, of all the capital in society, there was maybe half the people were buying housing, half the people were buying bonds because we had the housing optimists and the housing pessimists.
Yeah.
Now in 2019, the people who bought housing in 2014 have a lot of money.
A lot of money.
The people who bought bonds don't have a lot of money.
Yeah.
So we're going to see like the optimists actually have kind of more weight in driving housing prices. Mm-hmm. And so things go up and up. And once their optimism is proved wrong, or if it's proved wrong, now they have like no money to invest. So now the bond people are actually super high weight in what's being invested.
Yeah.
And so that's going to keep housing prices down for a number of years. So we have these kind of like heterogeneous, we would say in economics, so meaning different beliefs.
Yeah.
And how important they are in investments just wildly swing from year to year based on how these asset prices move and kind of reinforce each other. And so the suggestion is, what do I really want to be worried about? I want to worry about the fact that when people who are really optimistic are making these investments, they're going to be right for a while. Mm-hmm. And when they're right, they're going to take their returns from one house and buy another one and buy another one, buy another one. And so you have like a huge portion of the housing market being driven by these people with very optimistic beliefs. Yeah. More optimistic than the average person in society. Yeah. And if it's relatively hard to bet against them, which it is in the case of housing, then you can get kind of wild swings in asset prices. And the interesting thing, how this links to the savings glut, I think, is that basically you had a lot of investors that are relatively optimistic about housing compared to other asset classes. So like if you look at where you've seen the biggest run-ups worldwide in housing prices the last decade, like I don't think it's a coincidence that the correlation between, say, how many investors from East Asia I have in the city and the housing price run-up is like, where have we seen it? Singapore, Auckland, Sydney, Vancouver, not so much Montreal, not so much Boston. You know what I mean? Yeah, for sure. And so it's not just that there's a lot of savings coming from these developing countries. Yeah. It's that it's that those investors are relatively optimistic about the return on housing compared to the return they can get on other assets for a variety of historical reasons.
You mentioned a couple of things that I thought were that were interesting on this notion of this sort of the optimist kind of driving prices, and who's if you had bought homes. The one thing there was a paper who was it? It was a Yale academic. It's called the leverage cycle, and he kind of made this point where. And I thought it was the one thing I find interesting a lot of times with academic literature is kind of, taking it, reading it, and like looking at it in our environment. Like, is this happening? You know what I mean? Like, just because I'm on the ground, it's like interesting to see sort of these things play out. And one of his narratives is exactly kind of what you're saying is if you look at everyone who bought houses 10 years ago, obviously they've seen a big run up in their prices. And what's interesting is that they now, or many of them, even if they're not optimistic about the rise in prices tomorrow, even if they're pessimistic, a lot of those people are the ones who are lending money to private lenders so that the optimists can just go out and buy pre-construction condos, right? And there is this kind of cycle going in where, even the pessimistic investor, they're lending it because they don't care because the money's backed by a mortgage, right? And it is interesting how when you have these booms in housing markets, it's the optimists in many ways that set the prices because, they're just more optimistic about the growth in house prices and not as constrained by incomes, right?
Yeah, it's actually interesting. So you think of, if you think of the leverage cycle paper, what does it mean for policy? So effectively we're, through a number of policy levers, we're really subsidizing the optimists.
Yeah.
Right. So beyond just the kind of normal, tax treatment of housing returns, we're doing things like if I'm pessimistic, what do I care? I'll give the money to this private lender, or I'll give the money to a bank, for example, an investment bank. It's going to be guaranteed by the government, the loan. Then who cares? This is why I think the recourse loans. I just it's hard to see that this won't be a problem. So especially if I'm investing from overseas, I'm investing at huge leverage. So, think if I pay 10% down and housing prices double, I've earned a 10x return on my investment.
Yeah.
So normally you would think, on the other hand, I'm taking a huge amount of risk because the house price fall 10%, I lose everything.
Yeah.
But the interesting thing, if house prices fall 20%, 30%, do I lose more than everything? In theory, no, because in theory, yes, because the loan's recourse. In practice, if I just fly back to Hong Kong, good luck, right? What's going to happen is it actually possible if we saw, say, a 20% decline in Toronto house prices to get that money back?
Yeah.
I mean, I doubt it, right? So, you can look in the US, some states were recourse in 2008. I am unaware of banks that were able to recover that money by hand, right? Yeah. Maybe from certain commercial investors, it'll be slightly easier, but they can always go bankrupt. Yeah. And they're not stupid, so they're going to structure their housing investments in a way that if their investments in Toronto go sour, they don't have to lose the whole company worldwide. Right? So so it's a really important idea to have, how lots of savings plus differences in optimism can drive asset cycles, because how that interacts with idiosyncratic policy is really interesting. Yeah, and actually, this is the interesting thing too. If you think of Canada, trying to explain Canada's housing situation with some Canada-wide policy, it's wrong on two ends, right? First, the run-up in house prices has not been national, even in other states that are growing. And second, the run-up in house prices has been international. Yeah, happened outside of Canada, and Australia has a very different policy environment than Canada does. And so, when people are why is there a run-up in house prices because of this factor, this factor, this factor, and all idiosyncratic national Canadian policies, this can't be right? Yeah. There's something more broad and more general and more worldwide that leads to Toronto and Vancouver having the run-up that they've had. And if you're an optimist, you're going to say, well, they're very attractive cities, especially for immigrants. And I mean, if you look at the GTA has negative domestic population growth, right? So you better believe that it's very attractive for immigrants, because otherwise the population of the whole region is falling.
Yeah.
And so you think that's going to continue, and the city's going to be, or the region's going to be 10 million people instead of 7 million in the future. And so the land's just going to become more and more valuable. Rents are going to continue to go up. And that's why I'm investing. So that's what the optimists, I assume, are thinking.
Yeah.
And the pessimists are thinking, right now we're in a situation it is not hard to find $1 million house renting for $2,500 as soon as it's sold, in many areas of the GTA. And so for example, you'll know, my neighborhood, the Annex, we just had a house sell for $5.3 million, west of Spadina. It's a very nice house, but at a rent to price ratio of 400. So the house price is 400 times the monthly rent. That's something like $13,000 a month. So I checked in the entire GTA, I couldn't find a single non-furnished rental including on the bridle path, wherever you want to look, on MLS right now for $13,000. So, there's full houses for sale or for rent on Admiral Road for $7,000. So it's just tough to believe, this isn't some weird idiosyncrasy, the split between price and rents of outer York region suburbs. It's pretty common. And so, the pessimists are going to say, well, we're already at a situation where the prices and rents have diverged an incredible amount. We basically have no examples in history of rents rising at the kind of rate they'd have to rise to equate these things. If anything, over this year, rents have fallen in the GTA, not risen, at the same time as we have housing prices continue to rise. And so these two groups are battling it out. And the idiosyncrasies of Canadian policy we should be focused on is, why is something other than the average belief driving housing prices? And that's where you think, well, this run up in house prices the last decade or so has put a lot of investment capital in the hands of people who are very optimistic about housing.
Okay. And I want to ask you a couple of things, because you've mentioned several things that make me think. So before I go into sort of this question about why is the average belief driving housing, you mentioned something about prices and rents that I've been wondering, and I think it's a good kind of time to bring it up. So in a lot of the literature, of course, there's this idea that we're looking at home prices as an asset, as an investment, and its value is just based on sort of the rents that you expect to generate in the future, effectively deducting your expenses, so on and so forth. Yep. So we're treating it we're kind of valuing it the way we would say equities that are returning dividends and those types of ideas.
And of course, adjusted for people living in a house versus renting it.
Yeah, and I guess that's sort of one of the things I wonder about is when we're looking at house prices, of course, it's of course more than just an asset, right? Because there's a lot of number one, renting is not a perfect substitute for owning, meaning It's not like if I'm looking in the Annex, I have 10 homes for sale to choose from and 10 homes for rent that are identical, where I could just easily pick one or the other. There's no security of tenure in a rental, meaning if I rent it, I can get kicked out next year. And then of course, there's sort of these other personal utility, I can make it my own, I can renovate the kitchen. So I guess I've always wondered, is this idea of prices, rents, and this tight relationship, is it a perfect relationship? Are there gaps because it is a different type of investment?
Yeah. So a couple of things. We should also, in Germany, they consider sometimes the rentals better than the ownership, because if you needed to say move cities for a job, you're sure glad you're renting, right? And not owning. So sure. It's not always obvious that the ownership is better just on consumption grounds. The second thing though is that in Toronto's case, we can look at people who own the house but aren't living in it. So say people who move and keep their old house, they can either sell the house or rent it. That's a kind of more sensible comparison, literally the future stream of rents or the capital I get from something is what I'm comparing.
100%.
We have many examples like that. And the third thing is that, of course, it's true that most people prefer to own because they want to make the kitchen their own. They want to that they don't want to get kicked out when the owner decides they want to move back into the apartment or whatever it happens to be. But that's always been true.
Okay.
So to get changes in the price to rent ratio, I need some change in the relative kind of consumption utility of owning a house versus renting it. It's not totally clear to me that like owning versus renting in 2010 and owning versus renting in 2020, or owning versus renting in Toronto versus owning and renting in Kingston, that there's some kind of change along those margins that lead the price rent ratio to vary. So this is why, when we're trying to think about what's a kind of normal price to rent ratio given the interest rate, we've already got kind of a little bump built into these models for people preferring to own the house, but the model is imposing that preference for owning a house versus renting is not changing over time. So there are some changes, like the 30-year mortgage I mentioned earlier, just makes it easier to own a house. Is less I'm less bound by my own liquidity constraint, my own. And so that's going to cause a permanent bump up in demand for housing versus renting.
Yeah.
You might also think with, say immigration from East and South Asia, where there's a premium on home ownership compared to say like immigration from Germany, where something like 40 people are homeowners, that might cause a permanent shift in the price to rent ratio because people's idiosyncratic preference for owning a house is more. But like, how much could that be? Would I pay like, if I got no housing returns at all, am I willing to pay twice as much for a house versus when I could rent? I understand that like there aren't as many options, but many people are buying condos. There's tons of comparable things you could buy or rent. Pay 3 times as much, 4 times as much. Like at some point, it's too much, right?
That's actually very helpful. That was a very helpful answer. Now, kind of, if we return to this idea that low rates sort of and acceleration in borrowing help fuel the US bubble and bubbles in generally, I think it'd be good to talk about a paper that you shared with me by Kaplan, Mittman, and Violente, I believe, The Housing Boom and Bust, it was titled, that challenges this notion that the US housing bubble is largely driven by easy access to credit. And they came to a different conclusion, which I thought was really interesting. And maybe you can kind of just unpack at a high level what they found.
Yeah. So these guys are doing really cool work. They're super linked to that leverage cycle work that we've talked about already. And essentially they want to write a model that could be solved empirically, where they're going to try to get at, could the low rates have driven things? Basically what drove the US housing bubble. So the weird thing about the US housing bubble compared to Canada is that it was really nationwide. So it hit cities that were super constrained in your ability to build, like your San Francisco's, but it also hit like Phoenix and Las Vegas, like you can build whatever you want. Okay. Yeah. So this is kind of strange. Like the land's basically free on the outskirts. Like how could there be a housing run up? And so some people are like, well, the explanation is that the interest rates were super low. Anyone could get a loan regardless of their credit, regardless of their assets. And so people with no ability to invest otherwise were buying housing. And especially if the loans were non-recourse, like this is great. I'm like a waitress, like in The Big Short. I'm a cocktail waitress, and you're gonna give me loans with nothing down to buy housing, so I keep all the upside, and if the housing goes bad, I just send you the keys back so you get all the downside. Like, yes, I'm interested. In housing, right? Especially if the returns are tax free. And so there was a lot of suggestion that that the housing cycle was just driven by these really, really low rates that we saw throughout the 2000s. Kaplan and co-authors said, this isn't quite right. As I mentioned before, if I were to give you $10,000 for free, right? What are you going to do with it? Like, you could buy housing, but if you gave me $10,000 for free, I might just put it in the stock market. I might do all sorts of things. Yeah. So in their quantitative model, you look at like the geographic patterns of where you have the run up. They're like, it's just really hard to explain the patterns of foreclosures that we saw, the patterns of who was investing, just with interest rates being low. What seems more plausible is that I put a bunch of money in the hands of optimists. We had a run up in housing prices for a few years. Now those optimists, that cocktail waitress in The Big Short, has a lot of money. And
Mm-hmm.
this is the person who's very, very optimistic about housing as a return. And so they're going to invest and invest and invest. And what's going to happen is that when we have beliefs change rapidly, we're going to see right away, like just foreclosures go way up, right? These people are going to pull out of housing altogether. And now the housing market is going to be dominated by bears for years because they're the ones with any money left. And so, yeah, so their suggestion in their model is if I were to have, say, kept interest rates a point or 2 points higher, it wouldn't have caused a huge difference. Another way you can see that is like take Toronto. For some of your clients, like take your most optimistic client.
Okay.
What return do they expect on a housing investment over the next, say, 3 years?
If they're investing in housing, I think they expect prices to go up. Like most people probably think prices go up 10% a year.
Okay.
Or 8% a year.
So if I expect housing prices to go up 10% a year and interest rates are 3%, I'm interested. Okay. That's a good return. Right. So, and I'm investing with, 5 to 10x leverage. So I'm really, that's, a 70% return on my investment. Okay. If you make interest rates 4%, am I interested? Of course, I'm still interested at 4%. I'm still interested at 5%. At 5%, I'm earning a return at 10x leverage of 50% per year. Okay. So the kind of amount of change in interest rates, it just couldn't have driven the types of investments we saw in their model because the optimistic people are so optimistic that they're willing to invest at 3%, at 4%, at 2%, at 5%. And that's probably true here in Canada, that the kind of people that are driving, especially investment properties, if we look at what their beliefs are, if you were to survey them, I think you would find that their beliefs are so much higher than current interest rates that moving up or down 1% is not going to cause a huge change in their behavior. And in the model you mentioned, the Kaplan model, once the bubble's been going on for a few years, it's really not going to cause a change because I'm not even borrowing the money anyway. I'm investing out of my prior returns on housing. And so I'm not like going to the bank for a de novo loan. And so it doesn't seem like in these models that you can generate the type of patterns we're seeing just with interest rates. You really do need some type of heterogeneity in beliefs, some type of difference in beliefs where you've got some really optimistic investors in this class.
So the beliefs I get are critical, and I get this idea that it's not just low rates, because you're right, even if rates were 4% and we expect prices to go up 8%, I mean, I'd still buy. They don't need to be 2%.
I'd buy too.
But to what extent does easy access to credit matter? So it doesn't necessarily have to be low rates, because at the end of the day, if we use this Big Short example, it's easy access to credit that allowed the cocktail waitress to own 6 houses.
Yeah.
Right.
So actually, in their model, the easy access to credit definitely matters.
Okay.
The interest rate doesn't matter, but the easy access to credit definitely matters.
All right.
In particular, it matters in the way you might expect. If people who are very optimistic have easy access to credit, they're going to invest more, right?
Yeah.
So like in the Canadian context, if I allow you to take HELOCs at very low rates on your investment properties, well, now I just put a ton of capital in the hands of optimists, right?
Yeah.
If I make it impossible to do so on your investment properties, then I've made it very hard, right? Yeah. So like, if we talk about rules on, to what extent can I use unrealized returns on my my existing housing investments to buy more housing, right?
Yeah.
The easier I make that, not that surprising, it's going to kind of create more capital held by optimists in society that can be invested. Yeah.
That's awesome. That was super helpful. I'm going to wrap up with 2 quick questions that we've been asking all of our guests. The first one is that the theme of our conference is smart caution. What does smart caution mean to you?
Oh yeah. It's a great question, right? Smart caution in the housing sector, definitely for people buying for themselves, like buy a house ignoring the potential for returns because it's the house you want and the place you want to live. You'll never get in trouble if you do that, right? There's no way to get in personal trouble if that's your mentality. And of course, there are returns, so you can take those into account, but just be thoughtful about what the risks are. When we invest in stocks, like my savings are essentially all in stocks, I'm not going to take 5 times leverage, even if I'm optimistic about stocks, because I would like to retire someday, and even though the returns could be huge, the risk is just really, really crazy. And so with housing too, just be aware of what's gone on historically. If you're one of these people investing thinks it's impossible for housing prices to fall in Toronto for factor 1, 2, or 3, well, housing prices fell 40% between 89 and 95. I believe that Toronto had actually more net immigration in that period than they had in the last 6 years. You can check that to find out, but I'm pretty sure it's true. So whatever factor you think is going to drive the future, we have had this happen, and it's not impossible. Of course, we've had the Chicago situation too, back in the 1810s, where you would have made out like a bandit had you bought the land in the Loop. So, I'm not saying don't buy a house, but I'm saying if you buy a house and you're under the belief that housing prices can't fall, you're just empirically, objectively wrong.
Which leads me to our last question. Would you buy or sell a house right now then?
Yeah, I think it's actually interesting. There are enough investors in Toronto that there are enough houses for rent in neighborhoods that I care about. I've seen many detached houses for rent in the kind of 3,500 to 5,000 range in my neighborhood, where for $1 million, there's nothing. Okay, you can't buy the shoddiest possible teardown. At that ratio, I'll be renting. I very, very much prefer to own my own house, for sure, or even build my own house. It's just hard to justify for me at that ratio. If you told me, would you like to rent a place at 3,000 or buy it at 700 at the current interest rates, I'd buy.
Yeah. That makes sense. Awesome. Well, thank you so much for taking the time today. Really appreciate it. It was a great chat. I learned a lot. Hopefully our viewers learned a lot. And I think we got a lot of great feedback and insights from you. So thanks so much. Good.
Well, yeah. And hey, for your viewers too, if you're looking for a realtor, you definitely want the realtor who reads these papers and understands what's going on. So keep up the work, John.
You're going to think I paid you to say that.
No, definitely not.
Awesome. Thanks so much
Bye,
again.
buddy.